I'm Greg Hunter. Welcome to USAWatchdog.com. With us, my next guest made a big call in January of 2019. He said, listen, Edward, no matter what you think, the Fed is going to be forced to stop selling their bond portfolio. They're going to not only stop raising interest rates, but they're going to reverse course in 2019. The guy who made that call is Craig Hemke at TFMetalsReports.com. Craig Hemke, thanks for joining us today on USA Watchdog.
Greg, it's always a pleasure, my friend. Nice to see you.
Well, what a big call! A big call. I mean, back in January, people were like, "What? They're gonna start cutting rates and do what? What are you talking about? What's going on? Why did you make that call? And why is the Fed paying off on that call right now?"
Well, this has been pending now for a couple of years. It was stalled, I guess, a little bit when Trump was elected because the expectation of lower taxes, both at the corporate level and the personal level, gave a boost to the economy in 2017 and into 2018. But you could see, the cycle was on its last legs in the first place. But you also knew that, for instance, with the Democrats taking control of the House, there were going to be 100 different investigations from 100 different committees, and we were going to be talking about impeachment, and we're going to be talking about gridlock, and all of those things were going to impact consumer and business confidence, which was going to lead to the U.S. economy rolling over. You combine that with the fact that the Fed, the ECB, the Bank of Japan, and all the rest have created anywhere between 15 and $20 trillion of currency in the last 10 years. And that money sloshes around the planet, always looking for a home, and thus prohibits interest rates on the long end from going higher. And so when the Fed set out on their, I don't know, what do you want to call it, quantitative tightening scheme, and they're hiking the Fed funds rate, it was inevitable that they would invert the yield curve. And what that means, and I don't want to try to have to teach everybody geometry, but if you think of the yield curve as an upwardly sloping line where on the short end, interest rates are low, and then the longer you go out in time, interest rates increase, giving it a positive upward slope. That is considered to be normal and beneficial for economic growth. But when it inverts, meaning that interest rates on the short end are higher than interest rates on the long end, that is universally accepted as a precursor of recession. So you got this falling economic growth due to lack of consumer confidence and just the end of the cycle. But then also you have this inverting yield curve due to the Fed trying to raise interest rates. The two of them end up predicting recession. And that's what we could see coming. I mean, and now here we are. The first quarter GDP for this year was measured at 3.2%. It was only measured that high because they understated inflation. It was probably more like 2%. All guesses here in the second quarter of the year are about 1 to 1.5% with 3 weeks to go. By the third quarter, we will print a negative GDP. And in the fourth quarter, we'll print another one, which means we'll officially be in a recession. But here's the thing. You and I can talk about this. People on my site know that we're already slipping into recession. The data shows that. All the data, even this week, last week, the previous week, is showing that. But it won't be recognized as such until February. And why is that? Because the economist's definition of a recession is 2 consecutive quarters of negative GDP. Well, again, that won't be until the fourth quarter is in, and the fourth quarter won't come in until February. Well, heck, between now and February, all kinds of things are going to happen. And so basically that's what we're anticipating. What we're seeing play out now, right now, over the last 2 weeks, is the investment world finally waking up to this. And that is what is driving gold and silver prices. That's what will continue to drive gold and silver prices. And that's why when we wrote that report in January, we called it 2010 plus 9, meaning that 2019 was going to look a lot like 2010. And if you want to take a couple minutes, I can recap that again for you as well.
Well, you said that things would get bad again. And that's what happened in 2010. Things got bad. They had to have QE. They had to have rate cuts. I mean, that's basically what happened. That's the same replay. Oh, my gosh, things are bad, so let's cut rates down to, well, eventually it went to basically zero.
Yeah.
Either 0.15% or something like that. And then, the QE was 1, 2, twist, 3. I mean, it just went nuts. I mean, crazy. Right. And then they told this lie that it was sterilized.
Right.
It was, go back. That money, don't worry about that. And now we have 8-9%.
And we were supposed to be going back to normal, and the Fed was going to take its balance sheet back down to where it was in 2009. And it was all a big lie and a scam, creating this illusion that everything was still normal when everything broke in 2008. But here's the thing. Okay, so in 2010, as 2010 began, just as 2019 began, QE number 1 was finished. It was a one-off. It was a one-time deal. It was never going to have to be repeated. The economy was growing. There were, everybody, all these people on CNBC were talking about green shoots everywhere. People remember that. And it was, now everything's perfectly fine. And in the second quarter of 2010, the economy grew 3.2%. Yeah, we just had a 3.2% quarter, didn't we? But then the green shoots withered and died. The economy began to slow. We had a negative quarter for the fourth quarter of 2010 and a negative quarter in 2011, thereby being recession. And by November of 2010, here came QE2. So the Fed had somehow, through this illusion, had inspired confidence that they knew what they were doing. They had everything under control. That kept the dollar going up in the first half of 2010. That kept the metals going sideways all through the first half of 2010. It was only when the Fed admitted defeat and began QE2 that, they were exposed. The tide went out and people went, oh, wait a second. These people really don't know what they're doing here. This is all just a big experiment. And that was when silver went from 18 to 48 in 8 months and gold went from 1160 to 1920 in about 14 months.
And that's where we are right now. We're on the launching pad of that next.
Exactly. Because people are now, and that's why prices have gone up in the last 2 weeks, because people are now figuring out, wait a second, we were told just back in November and December that there were going to be 3 or 4 rate hikes this year. All the fancy pants 7-figure Wall Street economists like Jan Hatzius at Goldman Sachs, as recently as last November, were saying there were going to be 4 rate hikes this year. And yours truly, little dope out here in his MacBook in Kansas, was saying, no, it's not going to work that way. And that's exactly what's happening. And now here is where the Fed and Powell is getting their hand forced. Remember that yield curve I talked about earlier?
Yeah. Well, right now, the 1, 2, and 3 months money and 6 month money, that's Treasury bills, are paying more than the 5, 7, and 10.
Exactly. And it's even worse than that. The Fed funds rate, that rate that gets, every time there's a Fed meeting and they say, oh, yes, they're raising it or they're keeping it steady or whatever, is quoted in a range between 2.25% and 2.5%. That's what the Fed says. So to simplify it, everybody that follows it calls it an effective rate that kind of splits the difference. Let's call it 240. Okay? So that's where your Fed funds, that's your overnight. That's the shortest of short overnight rate.
1 day.
1 day, 240. Yeah, okay?
And the 10-year right now is 212. The 30-year is the 30-year is 263. The 20-year is
it's even worse than that. All the way out the curve. The 3-month is 235. The 2-year note is 185.
Yeah.
So let's just start there. We're at 240 for Fed funds. The 2-year note is 185.
Yeah.
Simply to reestablish a flat to upwardly sloping yield curve between Fed funds and 2 years, the Fed has to cut 75 basis points. They got to cut the Fed funds rate from 240 back down to 165. Then you'd be at 165 versus 185 versus 210 for the 10-year. That's 75 basis points, Greg. Nobody's talking about that.
Is the Fed panicked right now? Because to me, Powell came out as number 2. Everybody came out. We'll do whatever it takes. Draghi's come out. We'll do whatever it takes. Everybody's. Yeah. Is the Fed panicked right now?
I'm not sure panic's the right word. Because panic means like you're running around with your hair on fire, terrified. But I do think that they realize the corner into which they painted themselves, and they're trying to kind of mitigate the damage as much as they can. Look, from an economic perspective, traditional Keynesian economic perspective, the smartest thing that Powell could do 2 weeks from now. The 18th and 19th, I think, is the next FOMC meeting, Tuesday and Wednesday. Okay, so like 2 weeks from now. The smartest thing that Powell could do from a traditional sense would be to cut the Fed funds rate by 50 basis points. And thereby at least get it kind of, flat again. And not, to where you're definitely headed into a recession. But he's not going to do that. One, because Trump has already told him that that's what he needs to do. So he's not going to make it sound like Trump is telling him what to do.
He's going to cut by a quarter.
Greg, probably because he should. I'd say there's actually, the more I've thought about this over the last week or so, I think there's a pretty good chance he does nothing. That they're just going to come out and spin and say, well, this is still transitory and where the data is this and the data is that. And therefore, though we are now starting to think we might need to cut rates in another 90 days, that's what I think he's going to do. And you know what that's going to do? That is going to really exacerbate the situation, because the reason why interest rates all along that curve are going lower and lower is because money around the world sees that we're all headed into a recession, and therefore 2% for a 10-year note looks pretty good. And you can actually make money on that, because the bond you buy, that's a 10-year note with a 2% yield on it, actually goes up in value if rates go to 1.5% or 1. Okay, so there's demand for those kind of instruments, even though you and I think 2% for 10 years, who would want that? Well, global money managers want that, because they'll, especially when you look at Germany, which has got negative interest rates out to 10 and 20 years. Okay? So if Powell does nothing, all they do is just kind of try to spin it in language and all this kind of stuff here in 2 weeks. His problem going to get worse, because that all the people that invest in bonds globally are going to go, oh my God, they're asleep at the switch. This economy is going to it's going to go deeper into the tank in this next recession. Money is going to pile even in greater numbers into the 2-year note and the 5-year note and the 10-year note and everything else. And now he's going to be 100 basis points behind the curve in making it positive again.
But why would he? I'm not trying to debate you, because I'm not as smart.
Please.
But why would he come out and say we're going to do whatever it takes? I mean, if he was thinking about not doing anything, oh my God! I mean,
well, that's what he said several times this year. Is that the next time there's a recession, you can find this at the last couple of FOMC meetings and at a press conference. He's talked about the next time there's a recession, the phrase he always uses, every tool in the toolbox will be made available, which he's talking about QE, and he's talking about enforced negative rates if it goes that way, and everything in the toolbox. But they don't say we're doing it right now. They just say the next time that it will be available. Well, that's coming. And that's what's so important to understand. And that's where the comparison to 2010 is the most important topic that you and I can discuss at this point. Because in 2010, and I was getting ready to start TF Metals Report back then. I was watching this stuff every day and trading gold and silver and all that kind of stuff. 2010, you could have correctly diagnosed where this was all headed. In early 2010, you should have said, I don't believe this green shoot nonsense. And I don't believe that QE1 is the only QE that's ever going to happen. And I don't think the dollar should be going up. And I think gold and silver should be going up instead. And by July of 2010, though you were 100% correct in where this was all headed, you had nothing to show for it. In fact, in June of 2010, between late June 2010 and late July 2010, gold went down $100. From $12.60 to $11.60. So you could have been dead right, totally prescient on how this was going to play out, but then been shaken out in the summer of 2010 in that $100 down move. And then as soon as we got to August of 2010, gold then set off again from $11.60. It finished the year at $14.20. And then as confidence further waned, and as political gridlock and credit downgrades in the U.S. and debt ceiling debates and all that kind of stuff raged in 2011, it went to $19.20. And if you got shaken out in the summer of 2010, you were probably chasing the whole time, not believing it. And that's exactly, again, what's happened this year. We rallied to begin the year, and then we just had about an $80 or $90 pullback in gold that bottomed, I guess you could, a month ago.
1270?
Yeah. Bouncing 3 or 4 times off of its 200-day moving average and finding it as support. I mean, it was as textbook and as as much as you'd want out of a correction in a bull market. And now we're moving higher again. And again, why? Because people are waking up globally to this 2010 plus 9 thesis, which is the Fed, in fact, is not hiking rates. In fact, it's a recession coming. In fact, they're going to have to start cutting rates. In fact, they're going to have to restart QE. And all of this is headed your way. And that's going to prompt gold and silver to go up again, just like they did in 2010. Now, maybe not as much. I have no idea. I mean, I'm not going to sit here and say,
isn't it worse this time? I mean, back then, they never did this before. They invented a new term, QE. What? Quantitative money printing. I mean, Operation Twist, bond buying. I mean, they bought all the mortgage junk. And so, but it's different this time. It's like, whoa. We're going to try this again?
Right. It's different in two ways, actually. Yeah. Because
okay, go ahead. It's different in two ways. Hit me.
You get one bluff card, right? You get let's say somebody catches you in a lie. And they say, okay, I realize you lied to me, but generally I think you're trustworthy, so I'll cut you some slack and I'll give you a second chance. You lie to me again, I'm done with you, right? Isn't that human nature? Uh-huh. So the Fed has been lying to everybody since 2009 and 2010. But yet because, everybody else is lying and all the other currencies are kind of getting printed just as fast as dollars and the stock market's been going up, everybody's cut them some slack and let them maintain, have confidence maintained in the central bankers. But now, this next time, when the economy crashes, which it inevitably is going to do, and they're exposed for being, just these charlatans that they are, stringing everybody along, pretending like they've got it under control, well, then confidence in the central banker is going to crash, which means confidence in fiat currency is going to crash. And the only real alternative to fiat currency is sound money, and that's gold. So that's the first big part, I guess you could say, of why it's different this time. The other part is just the freaking math, man. I mean, we're up to $22 trillion a year in debt versus what, 10 trillion back in 2009?
Well, let me add to this, and I know you guys don't. I don't know if you're one of the people that talks about this, but this 21 trillion in missing money that Catherine Austin Fitts and Skidmore have. Yeah. I mean, they used Office of Inspector General reports. This Skidmore is a tenured professor of economics and expert in public budgets with a team of people, and they came up with 21 trillion missing in DOD and Department of Defense and HUD. And Craig, rank and file people may not understand this, but I'll bet you Jeffrey Gunlock does. I'll bet you Drunkenmiller, who just cashed out everything, I bet you he takes that seriously. I bet you they look. Whoa. I'm managing billions of dollars. You're telling me that the federal deficit ain't 22 trillion? It's at least 43 trillion?
Right. Yeah. So
that's a real number. That's a real number.
Right. No. Okay. Yeah. So
I'm sorry.
And even under current forecast made by the Congressional Budget Office and by the Trump administration, the deficit through and they only go out 10 years, through 2029 is $1 trillion a year. And that is under a forecast of 3% economic growth. Well, here's the thing, man. We're not going to have 3% economic growth. And so when it's 1% or negative, that means, if anything, tax receipts fall dramatically, right? So now your deficit explodes. It's not $1 trillion, it's $1.5 trillion, that kind of thing. So this idea that, the Fed can just keep doing what they're doing and everything just keeps marching along just fine. No. We are now finally at the end of the charade. It's lasted a lot longer than I thought it could. And it, I don't know, may take longer for it all to unwind than I thought it could. But now in 2019, we are right back to where we were in 2010. And I know it's been, hell, I feel this personally. All of the gold and silver that I've bought over the years and still hold, I bought for a reason. Now, that came with an opportunity cost over the last 6 years because, yeah, sure, you know what? If I just said, everything's going to be great for the next 6 years, so I'm going to sell all that stuff and I'm going to go buy myself an index fund on the S&P and I'm going to make a whole bunch of big pile of fiat cash and woohoo. Yeah, in hindsight, how brilliant would that have been? But all of the rationale that I had in buying physical gold and silver in 2009, 2010, 2011, 2016, 2018, earlier this year, all of that is still in place. It's all just finally coming to fruition, the rationale as to why I bought it in the first place. And it's been vitally important that people understand this, because you know what's going to happen now is eventually gold's going to break out this year. It's going to get above 1360, which is a key level for the first time in 6 years. The whole world is going to start to figure this out, and price is going to accelerate. And people that aren't buying it now or aren't buying mining shares now are going to get left behind. And then they're going to sit there and go, well, I'm going to wait for the next pullback. And then it goes further, and then it pulls back to where it was before, and you think, well, I'm going to wait for the next pullback now. And you end up chasing, and that's never a productive strategy. So anyway, the time is, I just can't stress this enough. This is all coming to fruition this year. What we wrote in January and what we began discussing on my site almost daily back during the fourth quarter of last year. The time is now to be acting and preparing, because all of this is, like I said, playing out right before our eyes and in real time.
Yeah, I used to do investigative stuff, and I did fraud and crime and stuff like that. You know what my overarching thing, no matter how big the fraud was, frauds end quickly. Right. They may take a while to develop, and this fraud has been one giant fraud that's developed.
Right. Right.
Do you think this fraud, when you're talking about the confidence in central banks crashing right along with the economy, do you think that's going to be the fraud ending quickly?
That's an interesting question, Greg. I first of all, I'm reminded of the old Hemingway quote about, how'd you go broke slowly and then all at once, right?
Yeah.
That's kind of what you mean by the fraud ending quickly. I don't know if there will be one dramatic event. There are all kinds of theories out there. Anybody can go to Google and type in, the big reset or something like that.
Yep.
And there are theories about, maybe there's like a week-long bank holiday and then some new currency is offered and all that kind of stuff. I'm more in the camp that it's going to be gradual, because mainly just of the intertwined nature of the globe in the financial system at this point. I think a more likely scenario is that as this all begins to crash and unwind, the dollar creditor nations, be it China, Russia, Brazil, India, I mean, you name it, all these countries that have dollars in their reserves are going to say, I think the day of the dollar having this dominant position has passed. So let's all band together and let's offer, just for us, an alternative, and we'll trade in that currency instead, rather than using a dollar as the basis of all of our currency. Frankly, the U.S. is making that problem more likely and more worse. The way we bully now everybody that doesn't toe the line that we want diplomatically, we shut them off to the SWIFT system. We threaten economic sanctions. We kick them out of our banking system. I mean, we are exacerbating that problem and pushing everybody, all these other countries, in that direction. So I don't know if it'll be, just a big global reset as much as it'll be other alternatives are offered to what's called the exorbitant privilege of the dollar's reserve currency status. And then that's when it really gets interesting, Greg, because the U.S. has cooked up all sorts of schemes, such as getting the Saudis to price crude oil in dollars, right? Or how about this? I was just watching today, people lamenting about, it was Tucker Carlson. Tucker Carlson just a couple of days ago did a monologue about U.S. policies that have encouraged the shipment of jobs overseas.
Sorry.
Okay. Now, you could say, taxes and all that kind of stuff. But again, by shipping products overseas and getting them made overseas, and then shipped into the U.S. is just another way of creating more demand for dollars. So we print all these dollars, and then they get shipped around the globe because of this demand for dollars and for goods and commodities and that kind of thing. The countries that produce those commodities and those goods then are stuck with their dollars because they sell them to us and they get dollars in return, and then they sit on them. And a lot of times they buy treasury bonds with them. And those dollars, all these trillions that have been created, especially since 1971, in a sense are incubated from the system. They're tied up in treasury bonds and the like, okay? But they're still there, right? So that's how the U.S. has gotten away with all these massive deficits and all of this spending and all of this fiat creation over the last 50 years and not had runaway crazy inflation. But what's coming, once the dollars, that demand for dollars from all of these creditor nations starts to fall off and disappear, well, those dollars are still out there and they're all going to come back here to our shores. And when that happens, that's when you finally start to get this kind of runaway, if not hyperinflation, because you've got so many more dollars than you have demand for dollars. That lessens the value of the dollar. That means goods go up in cost. And so all this talk that we've had about, people have been worried about hyperinflation, even Weimar style, inflation, Venezuela style inflation, all that stuff. I don't know if we'll get that bad. But this idea that you get 20% inflation again is certainly plausible and feasible. And so then all that kind of runs together to, political and societal unrest and everything else that we're worried about on a long-term basis. So anyway, that's a long answer to what was a short question. But I think it's more of a procedural process than it is just one big reset. But that's just my opinion.
Well, we already got, you have people that, 75% of people or 78%, I can't remember what the poll, but a high percentage of people somewhere in that neighborhood live paycheck to paycheck. What John Williams says is roughly 10% inflation on people.
Right.
And boy, it doesn't take too long for you to, unless you're getting a 10% increase in your wages every year, which that ain't happening.
No.
So you're seeing the stresses of that right now. Homelessness. The homelessness. Yep. They have 70,000, 65,000 homeless people in Los Angeles.
Right.
Right.
No, absolutely. And that's going to get exacerbated. And at the end of the day, Greg, that's why, if you ever sit back and think, because you and I are about the same age, and I know my dad worked and my mom worked as a teacher. But they didn't make that much money, but yet they still put all the kids through college and had a nice house and drove 2 cars. My dad belonged to a country club and all that kind of stuff. And nobody does that these days unless they're making about 2 bills, right?
Yeah.
And it's all because the cost of living, the tax situation, all this stuff, and it's all to feed the beast, to keep inflation going, to keep the banks going, to keep the money supply growing, to say that there's growth because of that. And all of that is going to come home to roost. You're right. I've seen studies, Greg. 65% of U.S. adults don't even have $500 in the bank.
Yeah, that's sad.
Okay, so what are they going to do when all of a sudden, you can't substitute anymore. You can't just say, well, I don't eat steak anymore. I eat hamburger. Well, what are you going to do when hamburger's $10 a pound? And so these are all, these are much more, broad topics that we talk about at my side a lot every day. But these are all the things that are pending because of this monetary madness. But the big kickoff is the U.S. economy and the European economy and everybody else kind of finally tipping over into recession again, exposing the central bankers, exposing how the system is not only corrupt, but kind of zombified with banks. And then that kind of will lead all the rest of these dominoes to tumble into each other. You and I, when we were communicating last week, we also talked about Deutsche Bank.
Ah, that's right.
We talked about zombie banks. That might be where we want to go next.
Well, Deutsche Bank, Nenner came on and said that Deutsche Bank, if they got below 640, which, we got this little run up in the stock market, and Deutsche Bank is now up above 7. It was in the 6s.
That's back under 7.
Oh, it is?
Yeah. As we record, it's back down to 670.
Oh, yeah, 673. Oh, my gosh. And this is in an up market. This is in a market where we've had a 500-point day, a couple 100-point day. I think it's up to, Friday's up. This is Thursday's up. We've had a pretty big up week, and yet Deutsche Bank is 673. He said 6. I was surprised at how direct Nenner was. He just said, well, and he worriedly said, if it goes to 640, on my charts are saying it's going to go to 0.
He knows more about it than I do, so I'll take his word for it.
He's, he's not a guy. He's not a chicken little guy. He's just a psycho guy. But everybody is saying this is awful. The whole Deutsche Bank, which is, he said, well, it's not just Deutsche Bank, it's all the banks. So it's, it's not just one roach, you got a bunch of them.
Right.
And so, but it would be the roach that's the biggest, nastiest, stinkiest, squeeziest, most yellow roach when you step on it, roach.
Right.
And it ain't going to help the world situation if this thing gets out of control.
And folks will remember, first it was Bear Stearns in 2008, and then it was Lehman and AIG. And not coincidentally, when it was finally Goldman's turn, that's when all of a sudden TARP came out. But that's a whole topic for another day. But the banks are all interconnected. It's particularly true in Europe, where one bank owns another bank's debt, who owns another bank's debt. I mean, it's a whole circular chain.
Could this get out of control? Could this?
Oh,
I mean,
absolutely.
seriously, could this get out of control? I mean,
Yes.
I'm not saying that you're forecasting the end of the world.
No,
Because
here's the thing. Deutsche Bank is the national bank of Germany, right? But in 1998, they bought Bankers Trust, which was a big derivative bank, if you will. They played the derivative market all the time, which has only since exploded, exponentially in the 20 some odd years since. Deutsche Bank is essentially, think of it as just a big, massive garbage bag full of derivatives. Okay? Which, now the apologists for that and the people that have an interest in being permanently bullish will say, well, yeah, and that's no big deal because, yeah, it may be trillions and trillions and trillions of face value derivatives. There's a counterparty. It's not just their own risk. They're not on the hook for that. There's counterparties to that. Wait a second. I don't care about the counterparties. I care about the party, Deutsche Bank. Because if they drop the ball on their end because they go bankrupt or whatever, then all of those derivatives are, let's call it, stressed. How's that? Is that a nice polite term?
Yeah. How about defaulted junk, trash?
Yeah. Does that sound familiar? Does that sound anything like 2008?
Yeah, this is listen. I mean, Lehman Brothers is a kiosk compared to Deutsche Bank.
Yeah, no doubt about it. And here's the perverse thing about it. I got to add this, though. Here's the perverse way that markets operate this year in 2019. I mean, almost everything's dominated by HFT, high-frequency trading, algorithm, written, computer program trading, okay? Probably 90% of global trading in equities, commodities, whatever, is all done by computers that are pre-programmed to take cues and then buy or sell, all these different assets. Well, I can see this scenario where Deutsche Bank goes down the tubes, right? Prompting the ECB to act and, give them an unlimited lifeline of a couple trillion euro. The markets then perceive that as euro weakness, right?
Yeah.
Well, the euro is about 57% weight of the dollar index, where the dollar that you see quoted, when you see a headline that says, oh, the dollar was stronger today in heavy trading. Well, they're quoting the dollar index, and the dollar is weighed against a basket of all the other major fiat currency, the euro, the yen, you name the pound, sterling, the Canadian dollar, whatever. Well, the heaviest weighted part of that index is the euro at 57%. So if they think of how this could happen, at least work out in the short term. Deutsche Bank goes down or gets really stressed out. The ECB, Count Draghi, floats them 2 trillion euro or some whatever, you name the number, to keep them alive. That's perceived as euro weakness, which would make the dollar go up. And the trading computers would see the dollar go up and they would sell COMEX gold. So on this extremely bullish scenario, you could legitimately see where in the short term, something like gold could go down. So, but in the long term, that would be disastrous, not only for the European banks, for the U.S. banks, Chinese banks, Japanese banks, whatever, because they're all linked together. They all own each other's debt. They all are counterparties to each other in the derivative market, which is like $500 quadrillion worth of derivatives now.
I think the whole system would cease.
Oh, yeah.
I mean, I think there would be no trading.
Right. And so in the end of the day, then, that gets back to just the one little part of this for which I feel responsible, which is the financial protection that's afforded to you by gold and silver, which have been money for millennia. Fiat currency is this fallacy of man. I mean, it dates back to the Romans, right? Where they're just going to just create script and call it money, and then you need more and more, and so you devalue and you print more and more, and eventually it's a confidence scheme, and the whole thing fails. And the list, my friend William Middelkoop in Amsterdam wrote a great book called, I think, The Big Reset or something. I look over my shoulder to see if it's on my bookshelf. And he, in his back of his book, has an appendix of all of the failed fiat currency, which is fiat currency, paper money, which is what the dollar is, or the euro is. He has a catalog of all, it's like 1,000 different ones that have failed over the centuries. The only thing that never fails is gold and silver too. And so it's not something where you rush out and you dump your whole IRA and you buy physical gold and that kind of stuff. Because, I mean, that would be foolish. Nobody ever wants to put all your eggs in one basket. But as what net worth protection, purchasing power protection, that kind of stuff, nothing has proven historically to be more effective than physical gold and silver. And that's what I think is the best thing people can do, especially if you've held off, or if the last 5 years you thought, well, they're going nowhere. I've made a little money in stocks and that kind of stuff. Well, the stock market looks like it's rolling over, no doubt about that. And as we talked about, everything going on with the Fed and the other central bankers, now would be a great time to start acquiring some before price moves away from you.
Your forecast between now and the end of the year. Now we already started getting, we've got big signals that he's going to cut rates, Powell.
Yeah.
And I've heard on Bloomberg, everybody's going to have to cut rates, is what the reporter was saying. So
right.
What is under that backdrop, what is your scenario for the rest of 2019 and 2020?
In that report that you cited that I wrote in January.
Yeah, I'll link to it again.
It concludes by saying that 2019 is going to be the best year for the precious metals since 2010. And 2010 was about 30% for gold and like 70% for silver. Because in the end, it went to $30 at the end of the year after starting at 18. Now, you can do the math as to what 30% and 70% would be. I'd be surprised if we go that far that fast. But I'll stick to that. I think we're going to have the best year that we've had since 2010. The big line, I mentioned it earlier, is around 1360. Gold, COMEX gold, the futures, haven't closed on a weekly basis, on the Friday weekly basis. They've not closed above 1360 for 6 long years. Anybody that's a technical analyst or, anybody that manages money looks at that and goes, well, till it breaks out above 1360, it's still technically in a range, which it is. So I think that's going to come, though. And once we get above 1360, that recognized breakout is going to accelerate momentum and interest in gold in all its forms. Futures contracts, the GLD, the mining shares, physical gold, unallocated accounts, you name it. And then we're going to accelerate higher. I'd say by the end of the year, Greg, somewhere between 1450 and 1500, maybe all the way to 1525 for gold. Silver's another story. I really don't know that's a whole other, it'll be dragged along with gold kicking and screaming because the bankers have their thumbs so heavily placed down below it for their own profit, or they're just pressing down on it and managing the price for their own profit. But that'll probably get away from them too, if anything, because that substitution effect we talked about earlier, I don't buy steak, I buy hamburger, that kind of thing. That plays out in gold and silver too. As gold goes up, people say, well, geez, I could buy 1 ounce of gold or 100 ounces of silver. So I'll just go ahead and buy some silver because it looks pretty cheap. And then it moves too. How fast it moves, though, I can't say with as much confidence for this year as I can gold.
Okay, but gold's good. Silver. They've always said. People tell me all the time that our analyst in precious metals is, well, one thing's for sure, it will outperform gold on a percentage basis. That's what almost everybody says. Just add a little B.
Well, historically, that's been true.
Okay.
But see, the problem, and it's like talking about the gold-silver ratio. You know what that is?
Yeah, it's how many ounces of silver it takes to make 1 ounce of gold.
Right. Now, historically, going back to biblical times, it was 10 to 1 or 15 to 1 because the price was determined through actual physical trading. I'll give you the currency and you give me the gold, right? But see, that's not how price is determined now. Price is determined through the trading of these pretend digital derivative contracts that act as exposure to the price. But there's no physical component at all. So when people look at that gold-silver ratio now that's 90 to 1 instead of 15 to 1, they go, oh, so silver's got a rally. Well, not necessarily. Well, all that 90 to 1 telling you is how fraudulent the pricing structure is versus, historical, because, again, it's priced off of this exchange of derivative contracts rather than the real thing. Now, when the time comes and this whole scam, Ponzi scheme of derivative contracts unwinds, well, hell's bells. That's That's when we're going to realize that again. But in the meantime, as long as price is determined through the trading of these derivative contracts, and as long as banks like JP Morgan have monopolistic control of the creation of said contracts and the market of those contracts, it's not just a simple no-brainer that silver is going to outperform gold.
Okay. TF Metals report. You have a subscription service. I think you offered a deal to USA Watchdog readers last time. Are you going to offer that again?
Yeah, you know what? We were able to help out quite a few people. I mean, I was surprised the amount of people that took me up on this last time. And I just, I think anybody that's watched this can tell, one, we've got a pretty good handle on where we're going this year. But two, I can't stress enough and be emphatic enough about, this is a time, again, that you need to be paying attention. With the economy going demonstrably lower and interest rates reversing, this is a time you need to be paying attention to gold and silver again. But I don't want to make it prohibitive for people. Not that the cost is prohibitive. It's only $12 a month. But we offered this last time, so we'll do it again. You can get half off your first month. I'll save you a whopping $6. It makes the first month cost $6. Okay, so what's that, 20 cents a day? But you can get half off your first month. You sign up for a subscription, a monthly subscription. You at checkout, you enter a code, a coupon code. There's this box there. Just type in gold 2019. And then you go to checkout, and your first month will be $5.97 instead of $11.95. You can cancel at any time, but if you continue after the first month, then you're going to start paying the full freight of 40 cents a day. But I found that was pretty effective last time for people that are getting interested in the sector again, to play along. The community is what makes it. I think I add value, with letting people follow along to my trades or advising them as to, what now is a good time because I think the price is going to rally. So if you're going to buy some physical, you might save yourself some money by doing it now versus next week, that kind of thing. But the community is fantastic. The people that post there, they keep everybody, we're all in the same boat, just like people listening to you and I today, recognizing that we've got to help each other out if we're going to get through this. And that's probably the best part of my site is the community of people, from all walks of life, all around the world, all political stripes, but they recognize that in the end, we're all in the same boat economically and we're all here to help each other. So anyway, thank you for letting me set that up again, Greg. Just go to TF Metals Report, find the subscription page, buy yourself a monthly subscription. It's not for annual subscriptions. It's only for monthly. And if you type in that coupon code of gold 2019, you get 50% off your first month and then stay as long as you want.
Just on a month by month basis.
Yeah.
Nice.
And anybody, it's like, if you subscribe to, Bloomberg or something like that, it's not feasible for Bloomberg to contact you every month and say, hey, you want to do it again? So you're set to auto renew until you cancel. But on you set up a little account for yourself and pick a cute little name, or whatever you want to be known by on the site. And then you can go in to that online profile on the site anytime and just find your subscription and click cancel. It's not complicated. I'm not trying to rip anybody off.
No, I got you.
So it's very easy to do. But again, the first month will be $6. Then every month after that is $12 if you enter that coupon code. And I think of the amount of people that signed on after we did this in February, I bet, Greg, at least probably 80-90% are still there.
Fantastic.
They've seen the value of what we do. And it again, there is, it may sound salesman-y and all that kind of, act now, right? But with all sincerity, this is the time that you've got to start paying attention to gold and silver again, because everything is playing out just as we expected it would. And so there's no reason not to think that where we go from here over the next 6, 12, 24 months aren't going to continue to follow that path.
Craig Hemke, TF Metals Report. Craig, thank you for joining us today on USAWatchdog.com and taking us to school. You were right before, and I suspect you'll be right again. Thanks, Craig, for coming on USAWatchdog.com.
My pleasure, Greg. Let's talk again soon.